Imagine paying someone to guard your life savings. Right. And then you find out they get a massive cash bonus every single time they put your money at risk.
Yeah, I mean, it sounds blatantly illegal.
It totally does. But depending on how your investment account is structured, it might actually just be a standard Tuesday on Wall Street.
Which is pretty terrifying.
Right. Well, welcome to the deep dive, everyone. We're pulling from some incredibly revealing excerpts today from a manual titled Defeating Churning, a guide to ethical investment practices.
It's an amazing resource, honestly.
It really is. And the mission for this deep dive is to equip you with the mechanical knowledge to spot this deceptive financial practice called churning. We want to help you understand the hidden incentives behind it and, most importantly, learn how to protect your own investments.
Yeah, because it is an absolute essential survival skill for anyone who has their money in the market. I mean, financial accounts are notoriously opaque by design.
Oh, for sure.
And the damage we're going to discuss today, it happens quietly in the background. It's disguised as, proactive, aggressive portfolio management by the exact professional you hired to grow your wealth.
That's the crazy part. Okay, let's unpack this. At its most basic level, stripping away all the fancy Wall Street jargon, what exactly is churning?
Well, fundamentally, churning is illegal and unethical excessive trading by a broker in a client's account.
Just trading for the sake of trading.
Exactly. The actual motive driving the behavior is that these trades have absolutely nothing to do with executing a sound investment strategy. They are executed solely to generate commission fees for the broker.
Which is just a massive breach of trust.
It is a fundamental breach of fiduciary duty. In a traditional commission-based structure, the broker's personal income is directly tied to transaction volume.
So if they don't trade, they don't get paid.
Right. If your portfolio sits untouched, just steadily compounding in a long-term index fund, the broker starves. They need velocity.
Wow.
But the hidden incentives actually go way beyond just standard trade commissions.
Yeah, because the source material highlights this glaring example where brokers are offered heavy incentives to push specific securities, right? Like newly underwritten ones from their own firm's investment bank.
Yes. We are talking about instances where a broker gets a massive 10% bonus paid directly to them just for buying a set volume of those specific shares with their client's money.
Wait, 10%? That is a huge conflict of interest.
It is. When you introduce a financial incentive of that magnitude, the broker's entire motivation shifts. It completely abandons any pretense of real asset allocation or, respecting your risk tolerance.
It just becomes a race to hit a quota.
Exactly. A mathematical race to unlock that massive bonus. The broker is essentially weaponizing the client's capital to enrich themselves.
I always think of this like a taxi driver intentionally taking the longest, most convoluted route to your destination just to run up the meter.
That is the perfect analogy.
Right, because you are sitting in the back seat, assuming they know a secret shortcut around traffic.
Yeah.
But in reality, they're just extracting maximum fare out of your wallet.
Yeah, they are just running up the bill.
But let me play devil's advocate here and push back on this a bit. Let's say I'm in that taxi, and we do eventually reach my destination. In portfolio terms, let's say my account is still making a profit.
Okay, sure.
The line on the graph is trending up. We are beating inflation. If my network is growing, why should I care if the broker is rapidly trading and skimming some heavy commissions off the top?
Well, that specific rationalization is exactly the psychological shield that allows churning to persist undetected for years.
I see. Because the top line number looks okay.
Right. Investors see a nominally positive return and just assume the underlying strategy is sound. But the unseen financial fallout of churning is really insidious.
How so?
Even if the trades are profitable, excessive trading creates incredibly high fees and massive tax liabilities for you, the investor.
Oh, right, because of capital gains taxes.
Exactly. Constant buying and selling generates short-term capital gains, which are taxed at your ordinary income bracket. That is a dramatically higher rate than the preferential long-term capital gains rate.
So even if the trade is a winner, the broker is charging a commission on the buy, another commission on the sell, and simultaneously handing you this massive immediate tax bill.
Yes, and that tax drag alone just devours the compounding effect of any actual gains you made. You are basically burning capital on taxes and fees just to tread water.
While the broker pockets the guaranteed transactional profit. That is brutal.
It is. The churning raises your costs without actually meeting your long-term investment goals. And unfortunately, this velocity-driven exploitation isn't just isolated to standard stock market trading.
Yeah, the taximeter doesn't just run on stocks. Let's talk about how this infects specialized, complex financial products. The sources dive into mutual funds, specifically A shares.
Right, A shares are a classic example.
For anyone managing their own retirement, you probably know that A shares carry an upfront load, which is a percentage fee you pay at the very moment of purchase.
And because of that heavy entry cost, A shares are strictly meant for long-term holding.
Right. The strategy is that over a decade or more, the fund's growth offsets that initial toll. So obviously, selling and repurchasing them within a short window, like 3 to 5 years, is rarely a wise decision.
Which is precisely why predatory brokers target them.
Wait, really?
Yeah.
Because it triggers the fee again.
Exactly. Liquidating a client's A shares to purchase a different set of A shares triggers another massive upfront load.
That is just mathematically destructive.
It is. And to make it even worse, mutual fund companies almost universally offer a built-in mechanism to prevent this exact problem.
You mean transferring within the same fund family?
Yes. They allow investors to transfer capital into any other fund within the same overarching fund family without incurring a new upfront fee.
So if the broker genuinely thinks you need different sector exposure, they have a way to adjust your portfolio for free.
Right. But if they recommend a change and intentionally move your money entirely outside that fund family, they are deliberately inflicting a new upfront load on your account.
Just to capture the commission on the new sale.
What's fascinating here is how this exact same behavior shows up in the insurance and annuity markets, too.
Oh yeah, the deferred annuities. The sources go deep on this.
They do. Now, deferred annuities operate on a totally different fee structure than mutual funds. They generally don't hit you with an upfront load.
Instead, they have those surrender charges on the back end, right?
Exactly. Surrender charges are basically severe penalty fees designed to punish you for early withdrawal. And they can last anywhere from 1 to 10 years after you sign the initial contract.
10 years of penalties. That is a massive lock-in period.
It is. So if an advisor persuades a client to liquidate a deferred annuity in year 3 just to purchase a shiny new annuity product, that client absorbs a brutal financial penalty.
While the advisor, I assume, collects a fresh, highly lucrative commission on the new contract.
You guessed it. The sources also point out this exact same pattern with life insurance salespeople.
Right, where they convince customers to abandon perfectly good existing policies and switch to entirely new ones, rather than simply renewing, just to boost their own commissions.
Which is actually illegal in most states.
And the glaring contradiction here is that these are inherently long-term products. How does a broker possibly justify moving them frequently? How do they mask the damage of, like, a 10% surrender charge?
Well, they use the language of optimization. They prey on the investor's fear of missing out, you know? They present these complex projections showing higher hypothetical yields on the new product.
While completely ignoring the guaranteed capital destruction of the surrender charge.
Exactly. It got so bad that states actually had to intervene. They implemented specific exchange and replacement rules.
So investors can clearly see the surrender penalties on new contracts side by side.
Right. It forces transparency so the client can clearly see the exact penalties being triggered versus the actual benefits of the new policy.
Okay, so if commission-based trading creates this massive incentive to overtrade, the logical solution for the listener would be to just pay a flat fee, right?
You would think so. But moving to a flat fee introduces a completely different parallel danger.
The wrap account.
Yes, the wrap account.
So a fee-based or wrap account is where the investor just pays a flat percentage, usually like 1 to 3% of their total assets under management, billed annually or quarterly.
On paper, it sounds like the perfect solution. It completely eliminates the incentive to overtrade.
Right, because they don't get paid per transaction anymore. But there is a dark side to this structure.
A very dark side. While it stops traditional churning, it creates the perfect environment for what we call reverse churning.
Reverse churning. Here's where it gets really interesting.
Yeah, reverse churning is when a broker does little to absolutely no trading, but they continue to take their flat fee percentage off the top every single year.
So they basically just stop working.
Exactly. They park the assets and quietly siphon their fee for delivering no active management whatsoever.
It's like fleeing a personal trainer who charges you every time you lift a weight because you realize they're just making you do useless exercises to run up the bill, only to turn around and sign up for a flat-fee gym membership that you never actually use. Except in this case, the gym is actively taking a slice of your bank account every year and doing nothing for it.
That is a great way to put it. The investor jumps out of the commission-based frying pan directly into the fee-based freezer.
So both structures are completely exploitable.
Absolutely. If a client isn't actively monitoring the relationship, they can be taken advantage of in either scenario.
Now, having explored how brokers exploit both of those structures, the discussion in the sources pivots to a really interesting structural outlier, a situation where the consumer is actually the one playing the system.
Ah, yes, credit card churning.
Right, credit card churning.
Yeah.
This is where an individual opens a series of new credit card accounts just to harvest the introductory rewards points, like
Yeah.
the airline miles or the cash back.
And then they just close the accounts or leave them unused once they get the bonus.
Exactly. But there is a key legal distinction here, isn't there?
A huge one. While broker churning and insurance churning are illegal because they violate a fiduciary duty, credit card churning is completely legal.
It's not illegal at all.
No, it's not. The consumer is just playing by the exact rules the banks wrote into their own promotional contracts. However, credit card companies absolutely despise the practice.
Oh, I'm sure they do. They lose tons of money on acquisition costs.
Exactly. So they have implemented intense algorithmic safeguards to prevent customers from repeatedly opening and closing accounts.
Which is such an amazing irony for the listener to think about. When a professional churns your life savings, it's this complex financial misconduct that can go on for years.
Yeah, and it takes regulators forever to build a case.
But when a consumer churns a bank's credit cards for some free hotel points, it's just a loophole. The banks instantly close themselves with a multi-million-dollar algorithm.
They cut you off immediately. Institutional retaliation is always faster when their own capital is at risk.
Ain't that the truth? Okay, so now that we understand every variation of churning, we need to talk about actionable steps. How do we detect this, and what happens to the offenders?
Well, the most important thing to understand is that traditional churning can only happen if a broker has what's called discretionary authority over an account.
Discretionary authority. So that means they can make trades without asking you first.
Exactly. They hold the keys. The ultimate defense is for you, the investor, to maintain full control. You do that by utilizing a non-discretionary account.
So that requires their explicit permission. Your explicit permission, I mean, to make any changes.
Right. You set a hard mechanical boundary. No trade can be executed without your recorded permission. And you set clear expectations up front about how active the portfolio management should be.
What if someone is listening to this and they realize they already gave their broker discretionary authority years ago? How can they spot the red flags if they are already in deep?
The most immediate piece of evidence is the transaction notices. By federal law, every time a security is bought or sold, you get a written trade confirmation.
So if you are getting daily or weekly transaction notices in the mail,
Or in your digital inbox, yes. If you are drowning in those notices and you didn't ask for a high-frequency trading strategy, that is a massive red flag.
what about the long-term products we talked about?
That's another big one. Frequent trades in long-term products like mutual funds or annuities. And finally, you have to look at your monthly statements. Don't just look at the bottom line. Look at the high total commissions. If those fees are devouring your profits, you have a problem.
So if someone spots this, who exactly do they call?
You elevate the issue directly to the federal authorities. You contact the U.S. Securities and Exchange Commission, the SEC, or the Financial Industry Regulatory Authority, FINRA.
And there's massive legal weight behind this, right?
Yeah.
The sources mention specific rules.
So absolutely. Brokers who do this breach SEC Rule 15C1-7, FINRA Rule 2111, and NYSE Rule 408C. The consequences are incredibly severe.
We're talking job loss, right?
Job loss plus FINRA fines that range anywhere from $5,000 to over $116,000 per infraction.
Wow, per infraction.
Yes. Plus suspensions ranging from 1 month to 2 years, or even permanent indefinite bans from the entire financial industry.
So what does this all mean? Distilling everything we've covered today, I think the core takeaway for the listener is that you must maintain an active, vigilant role in your portfolio. You have to protect yourself against both aggressive overtrading and lazy reverse churning.
If we connect this to the bigger picture, it just reinforces that knowledge and active monitoring are really your only true defenses.
Because the incentives are so misaligned.
Exactly. We are dealing with a system where financial incentives are very often misaligned with the investor's actual best interests.
It really leaves us with a lingering question to mull over. We've established that you can never truly set your investments on autopilot, right? Not if you want to avoid churning or reverse churning.
You always have to watch them.
But if paying a professional to manage your money means you still have to relentlessly manage them, How much value is the traditional brokerage model actually providing to the everyday investor?
That is the real question.
And is it time we demand a totally new way to align financial advice with financial success? Something to definitely think about the next time you get a trade notification. Thanks for joining us on this deep dive. We'll catch you next time.